Hello, my name is Fred Amrine and welcome to Student Loan Repayment. Today's focus is going to be the federal loan repayment process. This program is being sponsored by Repay 411, a company that specializes in student loan repayment, consolidation, and loan forgiveness. So let's get started. Repaying my student loans. We've talked about consolidating your student loans, and that's the first thing you need to do before understanding the best way to pay this. You have to know what your total debt is and how it's structured. So understanding the federal loan options, which are the best in comparison to private loans, you have a variety of them. There's actually 6 to 7 of them depending on what process you're under. So that's an important option that you have that you need to consider as you go through this process. The programs offer both fixed payments and payments based on your income and your total debt. So that can work to your advantage if maybe you are underemployed at this point in time or you lose your job, or it could actually hurt you in some sense if you get a significant increase in your pay and you're under one repayment program. It may change substantially. So again, there's a lot of flexibility within the federal programs. Only certain criteria or certain loans fall for loan forgiveness. So that's another option depending on where you're employed that you need to consider as you go through this process. You may be limited in certain repayment options as you go forward. As we had stated in the consolidation videos, we highly recommend you do a direct consolidation for a variety of reasons. One, the consolidation to simplify the process. But two, the direct consolidation will let you qualify for the Federal Service Loan Forgiveness Program. Only the direct loans do. And going forward, only the direct loans will really exist over some period of time. Next part of this is that you may have a variety of different methods to repay this. This will be based on the type of loans you have. Loans prior to 2010 were based on the program the school decided to be under. So it wasn't your choice, it was really the school's choice. They were all federal loans, it was just a matter of how they were sourced. So that's an important thing to realize. Each method has an advantage and it has to be based on your goals. So you may say, I want to get done repaying my loans as quick as possible. So you may be a combination of prepayment or monthly payments that are higher. Or you may say, well, I qualify for loan forgiveness. I want to have the lowest payment possible. All these things need to be considered as you go through this process. One advantage is there is no prepayment penalty. So as time goes on, if you want to get rid of these, you can repay them. And we actually, for our clients, have a prepayment method that we think is the best because it ensures that your amounts are credited correctly. Also, the important part is you have to understand who you're going to be working for, the career path you're going to be following, and what the income levels will be. This will be an important factor as you make your decision on what the best repayment process is for today and may change over time. So let's go over the repayment options you have under the federal methodology. One is the standard payment. That means it's going to be 10 years or 120 fixed payments. This is going to pay your loans back the fastest and it's probably going to be the most expensive. But again, depending on what your goals are, it may be the best option. Then you have graduated, which also is a 10-pay period, and you'll have increases every 2 years. Now the problem there is that it initially will be a low-cost repayment process, yet in the outer years it can get very expensive. It's not usually a repayment process we recommend. Then you have extended. Extended will mean there will be a fixed payment over some length of time, and the time allowed it is based on the total debt that you have. So as your debt increases, the maximum amount of time is 30 years. The last piece is the graduated extended, which is a combination of both the graduated and extended. Here's where you'll probably have one of the lowest fixed payments, at least for 2 years, but in the outer years can get very expensive. Another program we typically do not recommend. The last is the income-derived ones. This is based on your income and your debt levels. Under these programs, there's 3 major categories, and there's a 4th one that will be probably available in 2013. Income sensitive is used by the FEL program. So if you have loans that are on the FEL side, then you can use income sensitive. Income contingent are for direct loans. So you can use the direct program. Those programs are very similar. And the last one is income-based repayment, which is probably the newest and has the most flexibility, and it is used for both FEL and direct. But again, if you don't have the loans consolidated, this is why another reason for consolidation, you'd have to do this for each one of your loans through your servicer. A resource you may want to consider is going out to the studentaid.ed.gov website. There are the calculators that may help you through this, but each one of them will be calculated separately. You need to make some decisions on the long-term impact of your loan repayment process. Some loans will have negative amortization under the income-based processes, so you may not be paying all the interest, and you may have what's called negative amortization, where your debt level will actually increase over time. You also need to consider your tax filing status and the number of dependents. This also can have an impact on what your repayment method will be or how much you'll need to pay. Again, these are all factors that are considered in different methodologies. So what do you need to do? Your next steps. 1, you need to create a budget. Understand what you can afford each month and which payment method is going to best fit that goal. Or do you have a goal of getting your debt down as quick as possible? How do I do that the best way? Analyzing both the short and long-term impacts. So you may pick one thing or one repayment option, and it may change, or your financial situation may change, that you need to pick another or change to another. You can switch plans. Some plans do offer more flexibility, such as if you're doing income-based repayment, that it will work for you as a single person, and then you'll need to, and you get married, and say your spouse does not have college debt, you may have to file your tax return to still qualify for that plan the best way. And depending on your career path, you need to really consider, does loan forgiveness factor into the best way to repay these loans? Some of the clients we've worked for or worked with, we have saved them tens, $100,000 of loan through the loan forgiveness program based on their current career path and what it looks like over the next 10 years. We hope this video was helpful, and if you have further questions, please research or visit our research library for the other videos, and if you feel you need professional advice, please contact us. We'll be happy to help you. Have a great day.